And we shall begin with the session for today. Okay, we have around 250 participants joined in from the different Zoom meets. And while the other participants connect, so this session is a very quick session. And here I would be just explaining my research. So I'll be just sharing my screen. And I just did a small research upon one stock, and that is your Nvidia. And I posted the same on LinkedIn as well. And a lot of my students had queries upon to explain this research work upon NVIDIA. So basically, this is a different type of analysis which I did upon the stock of NVIDIA. And before trying to understand the kind of analysis which I did, so firstly, it's important to understand that what is this company NVIDIA for like all of those who have not been tracking this. So I'll put this session onto recording for for all of those who are unable to join the session can have some different analysis about different views upon the stock. And the type of analysis which I have presented for this particular stock can also be presented for the different stocks as well. So a unique analysis and my basic assumption or my basic concern about doing this type of analysis was that whenever we are tracking any of the stock and that particular stock tends to boom, right? Like giving more than 50% return, 60%, 120, like 200% return. So like we should be in a position to understand that whether out of that 100% risk, out of that 100% gain or out of that 100% return, how much can be attributed to the fundamental return and how much can be attributed towards that speculative return. So this kind of understanding or this kind of knowledge or insight is quite important for you to understand because when a stock is driven by fundamental return, it basically means that the stock might have some good cash flows, free cash flows. The stock might be making some good profits. The debt to equity ratio of the stock might be down. The stock might be gaining attraction as per the macroeconomic trends. The stock might be doing some more expansion opportunities, some more diversification opportunities. The stock might be getting some more attention from the government, right? Like taking up some new projects or diversifying it into like some new projects, like some new fields, right? So that is a fundamental return. But if these kinds of things are basically like not governing a stock or these kinds of things are not backing up the stock, then the return can be categorized as a speculative return also. Because in most of the stocks, there is a speculative component also, right? But in good companies, in positive, good cash rich companies, in good profitability companies, that quantum of speculative return might be too less and the quantum of the fundamental return might be too high. Okay. So one thing, if I just tell you, I did the same kind of analysis for this stock Nvidia. So first of all, for all of those who don't know that what the stock Nvidia does. So basically, see, Nvidia is a corporation. It's an American multinational technology company, like which is incorporated in USA. So this company is into your AI. So that is artificial intelligence, into gaming industry, into tech. And you all know that we have a boom of this AI, right? Like this artificial technology, this tech industry, this gaming industry, like is on a boom, correct? So ideally, we can say, or ideally, like one can argue that the fundamentals are backing up this stock. Because if I talk about the numbers, the stock has given more than 170 plus percent return over the past 1 year. More than 170 plus percent return. So ideally, like everything should have been backed up by the fundamentals, correct? But one thing ideally, like before, like whenever like we are trying to value up a stock or like we're trying to do a DCF model, that is a discounted cash flow model. So all the kinds of assumptions, be it for the growth rate, be it for the weighted average cost of capital, or like any kind of assumptions that we are like making to calculate the cash flows, that should be in a conservative manner. We cannot over explicit or we cannot make our assumptions so aggressive, right? So one thing is that see, like whenever we are trying to use the growth rate, because the growth rate is a very important component in calculating the cash flows of a company or the future cash flows of the company, and also the reinvestment rate, right? At what rate or how much quantum of amount the company is putting up towards that AI investment or gaming investment or to build up that infrastructure, correct? So we need to be in a common parlance or we need to work at a rate or that growth rate or the reinvestment rate must be appropriate. Even if a company has some boom of AI, technology, or gaming, we cannot have a growth rate which is far exceeding the expectations. For example, if we are like taking into consideration the growth rate of IT industries, or like be it any of the industry per se, we need to take at least the average growth rate of that particular sector over the past 10 years, or maybe the past year's growth rate, if that has been a part of that average growth rate, or maybe the growth rate of that GDP, or maybe the different formulas like for which like we can calculate that growth rate, like ROE into the retention ratio. But having the growth rates which are more than 30%, 40%, 50%, 100% are something which are not realistic. It can happen that in the real scenario, the stock might grow at a rate of 100% or 200% even, like in the least possible scenarios. But still, having a growth rate of 100% or 200% is something which is not explicit, because like whenever we are using the dividend discount model, or like whenever we are or like whenever we are trying to calculate that terminal value, we are using that free cash flow to firm or free cash flow to equity in the numerator and dividing it by the weighted by the difference between the weighted average cost of capital and the growth rate. So growth rate cannot exceed the weighted average cost of capital. And that weighted average cost of capital, it might be 10% max to max 12% in the current scenario. But the growth rate cannot be 100%. In that case, the free cash flow in the last year would be negative, correct? So taking an idealistic assumption, so those kinds of assumptions, I've tried to plug in the numbers, and I did some analysis. So I just broke down the numbers. So see, the price to earning ratio of this particular stock in 2022 was 55x. So before going further, like all this analysis is just for knowledgeable purpose and just for informational purpose. I'm not giving any kind of stock recommendation to buy this stock or sell this stock. I'm just telling you that this kind of analysis you guys can build for some other stocks as well. If you think that that particular stock has boomed over the past year, which is something excessive and not normal or average, correct? Because my job doesn't like allow me to give stock recommendations. So that is something, yeah. So price to earning ratio of this particular stock in 2022 was 55x. In 2023, this price to earning ratio became 110x. 110x, almost twice. A huge increase in the price to earning multiple. But what is price to earning multiple? Your price to earning multiple is the ratio of the current market price in the numerator divided by the earnings per share in the denominator, right? So EPS in the denominator is not a forward indicator or not an active indicator, I would say, for the economy. It's a laggard indicator, because your earnings per share, as told in the previous session as well, is nothing but the profit after tax divided by the outstanding shares, correct? And like when we talk about economics, like we have a concept about the leading indicator and the lagging indicator. The leading indicator is something that tells us about the future outlook of the economy well in advance before that event has actually occurred. And the lagging indicator is something that gives the result after that actual event has occurred. So the EPS, that is the earning per share, is a kind of a lagging indicator, because at this point of time, I cannot predict that how much profit a company will make in future. I can predict, but I cannot be sure about it. Because even if these numbers are predicted by top investment banker or the analyst, there is always a difference in the actual number after 5 years from now. So I cannot tell the actual number, but I can still predict it. But when I talk about the numerator part, that is the price part. Price is a leading indicator. If some good news comes in the market about the stock, or like some different kind of speculation comes in the market, the price might change. So when I talk about this ratio, that is a price to earning ratio, price in the numerator and earnings per share in the denominator. Even if the denominator does not change, or even if the denominator comes down, that is the EPS comes down, the ratio will rise, because mathematically, when the denominator is less than the numerator, the value of the ratio is higher. So price absorbs it all. Price tends to absorb all the news fast and also the future expectations fast. Because some good news in the market, some good speculation in the market might increase the price, but the EPS might be constant. So On account of this, like we need to be very much careful about the price to earning ratio, because the price to earning ratio, it takes into consideration both the forward indicator in terms of price or the leading indicator in terms of price and the lagging indicator in terms of your earnings. So this price can be very much fluctuating. So you need to be careful in terms of valuation. So as a result, I'm not so mindful about this number. I'm cautious about this number from 55x to 110x because price has taken that into account. But the net income earnings from 2022 has not doubled. The earnings in 2022 were 7.5 billion US dollars. So all these numbers are in dollars. But in 2023, it rose by a good amount, but only till $10.45 billion. If the earnings had been twice or at least like 1.5 times, I would have been happy to justify this price to earning ratio. But the earnings did not rise by a quantum of amount. The market cap in 2022 had been $450 billion. In 2023, it became as $115 billion, more at least 2.5 times. EPS in 2020 had been 3. In 2023 had been 4.5. EPS, like which like takes into consideration our earnings, it did not rise by much, by just 1.5 ka number from 3 to 4.5. Again, the higher price to earning ratio is not justified. The market cap will rise. The market cap will rise because it is nothing but the price of the share into the number of outstanding share. So if the price is taking that into consideration, because price is a forward indicator. If the price rise and basically the number of share remains constant, still the market cap will rise, right? Now, like taking into consideration the above numbers, so we can determine the ideal numbers taking into consideration the factors constant. So if I just change this to price to from price to book value to price to earning, because we are taking into consideration price to earning here. So just assume if the price to earning ratio had been constant in 2023 at 55x, just assume, or maybe 60 max to max. Still in that scenario, the market cap of Nvidia had been 55 into this earnings wala part. Just try to understand the calculation. We are trying to understand that if the P ratio had been constant as 55x, the formula for the market cap had been the current price to earning ratio into the new net income, that is 574.75 billion. Even if like it had been 60 or 65, the valuation number or the market cap number had not been more than 1,000. But here we can see it is more than 1K, right? $1155 billion. Correct? So therefore, ideally, if the price to earning ratio had been constant and the market cap had been $574 billion, the return on the stock, while just taking into consideration the price only, had been nothing but 574.75 as a new market cap divided by the 450 as the current market cap minus 1. The stock should have given just 28% return. So we can say this 28% is the only fundamental return of the stock. And the remaining 143% is the speculative return of the stock. And that is what I've tried to mention here. That fundamental return is based on its core operations, earnings, and speculative return is based on making gains without the fundamentals. Out of 170% return, approx 27% return or 28% return can be attributed to fundamental returns, and remaining 143% is speculative returns. And like, what is the formula for speculative returns? A new thing for this session. And that is why I tend to insist my students to like attend these sessions, right? So the formula for speculative return is nothing but I'll try to share this document, but like this document is freely there on LinkedIn, right? Like for everyone to access. The formula is nothing but your current year EPS, that is 4.5, into the current year price to earning, that is 110, divided by how much? Divided by minus the previous year PE, that is 55, divided by 168. So 168 was the price of Nvidia like 1 year before, and now the current price is approximately $441. So $168 the price before the rise. So 145% or like 143%, like 2 or 3% can be like here and there, has been the speculative return. So like just remember this formula. Now like one more point to notice, like whenever we are talking about the shareholders return, the shareholder returns, it ideally comes from three factors. One is the dividend yield, that is how much dividends like you are getting as compared to the current market price. The buyback yield, how much buyback, like when the company made the buyback of that share, how much yield like you got in terms of cash. So that is the buyback yield. And the third one is the debt pay down yield. It is nothing but how much debt of the company has changed as compared to its market cap, or how much debt of the company has changed relative to its market cap over the past 1 year. That's the debt pay down yield. So after calculating these numbers, the dividend yield has been 0.01%, not much. Buyback yield had been 0.67%, and your debt paydown yield had been 0.8%, which makes a shareholder yield of total as 1.43%. 1.43% ka total shareholder yield. So we can say that the fundamental return had been 27%. Speculative, the highest component was 143%, and shareholder return had been just 1.43%. So in this way, like you can gauge that whether the quantum of return had been or the higher amount of return had been due to fundamentals or speculations. Now, like some guys might argue that like we can take into consideration the future expectations and like discount that. But how? The growth rate has to be taken as realistic. You cannot take the growth rate as 200, 300%, or maybe 170% for the stock. For that, the rate or the weighted average cost of capital has to be more than 200%, like which is not possible. So ideally, this 170%, and still this stock of like Nvidia is into the mutual funds or portfolios of a large number of companies. But one thing that needs to be understood is that how much can be attributed to speculative part. Okay, so that is a short understanding of mine upon the fundamental return, speculative return, and shareholder return. If any of the queries are there like regarding this, you guys can ask me anytime about how did I calculate these numbers again. Because if this kind of analysis I've done for the stock of Nvidia, the similar kind of analysis can be done for penny stock companies also, micro cap, small cap, and mid cap especially. Large cap companies might not give so much return, 100%, 200% return, but this kind of analysis can be done for small cap companies, mid cap companies, micro cap companies. So this kind of framework can be done for those companies as well. Correct? So that is a brief discussion if I talk about how to calculate the fundamental return, shareholder return, and a speculative return for a stock.